How does a trade deficit impact economic history? Imagine a country that keeps importing more than it exports every year. What does that tell us about its economy and its history? A trade deficit happens when a nation spends more on foreign goods and services than it earns from selling its own. This situation is a key part of understanding how economies grow and change over time, especially within the framework of modern capitalism. Capitalism relies on countries trading with each other, and a trade deficit can reveal a lot about a country's economic health and its evolution. When a country has a trade deficit, it means it is consuming more than it produces. This can be good because people get access to a wider variety of goods and services, often at lower prices. For example, if the United States imports many electronics from Asia, consumers benefit from cheaper gadgets. But it also means the country is borrowing from abroad to pay for those imports. This borrowing often comes in the form of foreign investment, like foreign direct investment or buying government bonds. Over time, persistent trade deficits can influence a country's currency value. If a country imports more than it exports, its currency might weaken compared to others. A weaker currency can make exports cheaper and imports more expensive, which could help reduce the trade deficit. However, it can also lead to inflation if import prices rise too much. Historically, countries like the United States have run trade deficits since the late 1970s, driven by high consumer spending, a strong dollar, and foreign investment in American assets. Looking at economic history, trade deficits can be signs of a thriving economy if they are financed by investments that boost productive capacity. For instance, if foreign capital funds new factories or infrastructure, it can support long-term growth. But if deficits are mainly due to excessive consumer borrowing or unproductive investments, they might lead to economic instability or debt problems. Policymakers often try to manage trade deficits with measures like tariffs or trade agreements. These actions can influence international relations and a country's bargaining power. For example, a country with a large trade deficit might face pressure to change its trade policies or currency value. From a modern capitalism perspective, trade deficits are not necessarily bad. They can reflect a country's ability to attract foreign investment and specialize in certain industries. But if they are not managed carefully, they can also signal economic weaknesses or lead to financial crises. In the end, how a trade deficit impacts economic history depends on how it is financed and whether it supports sustainable growth. It is a sign of economic activity, but also a signal to watch for potential vulnerabilities. Understanding these patterns helps us see how economies have evolved and how they might continue to change in the future.